It's very cool to see such a good turnout here, and it's kind of interesting because the topic of my presentation, I'm quite positive actually, and we're seeing some trends in markets that are very encouraging. Like, we're at the start of something. So anyway, it's a macro presentation, which I don't usually do. I think, if you were here at my presentation last year, I talked about copper and gold, the only two metals that you need. There's a lot of macro in that, but it was really focused on the two metals. This is a macro dive. And I don't normally do these because they're so tough to do, and the macro is always in flux, but this is a very important moment in time. This is a really important moment in time. And what's going to happen in the next several months is going to shape financial markets and maybe the world for many years to come. So let's get right into it. These two men, Trump and Xi. Obviously, the world's a big place. There's many countries, there's many players, the Eurozone, Canada, et cetera, but really, China and the US run the show, and the rest of the world kind of follows. Sorry, it's true. And both of these men have very powerful personalities. Now, I don't speak Chinese, but I read a lot about Xi and the way he is, and also the Chinese culture. So whatever's going to happen, he's going to find a way to save face. He's going to find a way to look good for his people, and he's going to find a way for China to emerge as either a clear number two or at parity, with the U.S. And so we'll kind of explore how to get there. And I'm going to end it with kind of a forecast. Like I'm going to make an assertion. Could very well turn out to be wrong, but I'm going to say it confidently, so we'll see. It's tough. It's very tough to forecast these things. So let's jump into it. The Super Bowl is about to happen between China and the U.S., and we got it on Twitter today with Trump tweeting about his phone call with Xi, and then Xi's people put out a bunch of stuff about their conversation. It was very positive. They're trying to take a very positive tone on this. I think it was encouraging to financial markets. We saw stocks rise. The dollar came off a little bit the last couple of days. The 10-year yield also, came off a little bit after flashing sort of in the red light, warning zone above 4.8%. But I don't think it's going to be like this forever. I think that they're going to definitely go head-to-head, toe-to-toe, try to get the best deal for their country and their economies. But prior to getting into sort of the deeper stuff, like I want to just talk about some trends. So the 10-year yield rallying a lot in the last 4 months, from 3.6% to 4.8%. It pulled back a bit, but this looks like it could definitely push higher. I wouldn't want to bet against it right now. And rising, yields, in the U.S. are also pulling up the yields in the U.K. and Canada. So there's a very clear correlation there between those economies and those bond markets. But this bond market is completely different. So China is in a debt, deflation right now. Their economy is extremely challenged, and their data is pretty much faked up across the board. So it's actually much worse than the data that we see. They can't really fake up the bond market that much. So this is telling a story. I mean, this is telling a very strong story of, an economy that is in a downturn, and there's just too much debt, and price levels are falling, and so are bond yields. So this is the yield curve in the U.S., which was inverted for 24 months. The longest yield curve inversion in history came to an end a few months ago when the Fed cut interest rates back in September. And this is a bear steepening, of the yield curve. And it's usually very positive for metals, for oil, for gold. And according to this macro market cycle, we've just had a shift from the recovery phase, which is favorable for stocks, which we've obviously seen in 2023 and 2024. The stock market has done pretty well. And now we're in a boom phase. So this should be good for the things that we like here in Vancouver, like copper and gold. The dollar has had a very strong move, and it's actually the most overvalued it's been since 1985. So this is like 40-year high in terms of its valuation. You can see that chart as well. It paints the same story. And you can see, go back to 1985. What happened shortly after it got super overvalued? It sort of hit a red light level. Well, it fell very sharply because in 1985 they did the accord in Manhattan at the Plaza Hotel, and they got the dollar to fall sharply for the next 5 years. So we could be coming closer to something like that right now, in 2025. So policy uncertainty is absolutely enormous. You can see that huge spike. It's the most uncertain it's been since March 2020, the global pandemic. And that's why it's really tough to forecast this. But when you understand the problems and the incentives, you might be able to forecast what they're going to do, like how to solve the problem. So we had some clues from Fed Governor Waller. Previously, like a few weeks ago, the Fed was saying, or the market was saying, maybe Fed rate cuts at all this year, right? The Fed rate cut expectations dropped markedly. And now Waller comes out and says 3 or 4 rate cuts are still possible. With the S&P at 6,000, okay. And he's even saying a March cut is not totally off the table. That's extraordinary to me. The Trump nominee for the Treasury says China has a highly unbalanced economy, and he points out that the price levels in China are falling at -4% a year, and they need to do a rebalance. They need to rebalance their economy. So he's giving a very big hint and a signal that something is coming. So it's a very complex backdrop, and Trump 2.0 is going to be a catalyst for some big transformation in the global economy. Some key points on this graphic to point out. Again, China has a stagnating economy, a bunch of zombie banks, the largest banking system in the world. It's over $50 trillion. It's bigger than the US. The property bubble burst 3 or 4 years ago, and they've been in a downturn ever since. But it's been a very slow process because the economy is controlled by the government. It's not a totally free system. Also, on the US side, we have a deficit problem, a huge deficit problem in the States with a $2 trillion deficit, and a huge debt wall that needs to be refinanced. $7 trillion of paper needs to be refinanced in 2025, and that's actually part of the reason why the dollar has been so strong in the last several months, because the Treasury is crowding out the dollar market. They're soaking up the dollars. So when you have a lot smaller pool of dollars, you've got a scarcity, and the price of dollars goes up. And so it's kind of counterintuitive. Big deficits, high debt, strong currency. Well, when you're the dollar and you're the currency of the world, this is what can happen. So Trump has seized this problem. His team definitely sees this problem, and one of their key objectives is to weaken the dollar during his term. Yields. Because Trump is pro-growth and he wants to see stock market go up and the economy strong, we've seen bond yields rise. So they're getting ahead of Trump, in his economy and his plan, and this is creating a potential dollar short squeeze. And something I've learned in financial markets is that markets have a way of finding the stop losses, right? They have a way of getting to the levels where they induce maximum pain in the market, okay? And so I actually think that there's a very good chance in the first half of 2025 that we might find those levels in the dollar, in the 10-year yield, and it will cause the Fed and the Treasury to do extraordinary things. They might even do YCC at the long end of the curve, which is basically hold the long end rates at a certain level and monetize the debt, and the dollar in the process. So when was the last time the dollar was yeah, we talked about that, the Plaza Accord in 1985. We talked about that. So, this is important. China and the US, they need each other, okay? So, even though in a way there's a competition and they're opponents, and China would like to be the top dog, they need each other, right? And so this is very unlikely to spiral downwards, into a full-blown trade war or a war. I think that's very unlikely, and that's also what the stock market is telling us as well. So they're gonna find a way to work this out. It just might be a challenging process that could take some time. And I'm gonna tell you the way that I think that they might work it out. So, this chart is important. It's kind of hard to read because the government is on a year that ends in September, but Q1 of 2025 was the biggest budget deficit ever, basically, and it's a 39% jump, versus last year. So there's no austerity in the U.S. So we have $2 trillion deficit, and we just ran a $700 billion one in Q1. So that's an annual rate of almost $3 trillion. So that's what Trump is walking into. He's walking into a fiscal mess. And look at the forecasts for the budget deficit. Bigger. It's not getting smaller. It's stuck near $2 trillion, and there's a good chance that by 2029 or 2030, it will rise further, 2.3, 2.5 trillion. So not good. I mean, with the 10-year note yield at 4.7, the Treasury has a very tough time, trying to sell a lot of paper, at the long end. So they cram it in the bills. They sell it all at the front end, and they need the Fed to help them to do that. And I think that's why Waller said that 3 or 4 rate cuts is still on the table in 2025. Despite the fact that the S&P is 6,000, the job numbers beat, and blah blah blah. I mean, it doesn't. I'd say that if the Treasury had a smaller amount of paper to sell, the Fed would not cut rates here. But with $7 trillion wall in 2025, they're going to cut rates. And there's that wall, and there's another wall in 2026. So let's talk about China. We talked a little bit about the banking system, 56 trillion, off-balance sheet government debts. A lot of their data is faked up. Their home sales are dropping by 26% a month. Confidence in the economy is eroding. A lot of Chinese are buying gold. The government is buying gold. Population growth is declining, so they have a big demographic time bomb on their hands to add to the debt bubble that's bursting. PPI, deflationary, the CPI is stagnant. The yield curve has downshifted. Again, debt deflation. It's a spiral, okay? They are in a mess. So Trump knows he has the upper hand, but he also knows he can't set the bomb off because it will hurt him too. The hidden debt to GDP ratio. So this is the thing with China's data. It's faked up. You have to dig deep to try to really understand it. Their debt to GDP ratio is actually above 300%, and it's only been rising the last few years. Trump, trade possibility. So he wants to put 60% tariffs on all China goods. I mean, that's what he's talking, like that's the starting point, at the bargaining table. If that happens, like if they just said, we're gonna do this right now and it's gonna start right now, it's going to be a mess, right? He can't do that, right? The worst thing he can do is he could maybe do like a small amount, like 1 month at a time, and maybe get to that in 2 or 3 years, but that would still be very challenging. But he's going to talk big at first to try to get more. He's going to do the trade deals with Canada, in the EU. We can talk about that in a totally separate conversation. And then he's going to extend the 2017 tax cuts to add $4.6 trillion to the deficit. So we're running a $2 trillion deficit that's getting bigger, and he's going to do the 2017 tax cut extension to make the deficit even bigger. So this swelling of the COMEX stockpiles is a product of the tariff fears. We know 2017 or we know 2024 was a stellar year for gold. It rose in all currencies essentially and up almost 30% in the dollar. And I'm switching to gold because gold is an important trump card for China, and that's sort of where this presentation ends. Gold has diverged from all these correlations. Dollar, yields. Gold is supposed to fall when the dollar rallies. Gold is supposed to fall when the 10-year jumps 100 basis points in 3 months. It didn't really fall, and actually the last month it's been rising, and it just broke out of this pennant pattern, and it's heading for over 2,900. So the factors that are driving this shift in correlations is China buying, China buying, China buying. Now, according to the official data, they left the market for 6 months last year, and they came back in at the very end of last year and bought a little bit. Chinese yuan price of dollar is at an all-time high, 20,000 won per ounce. But this is the real story, folks, and this is the important thing to take away from this presentation. The official data is not correct when it comes to China. They have been buying a lot more than what they officially report, and there's a lot of good places that you can get this data, and this chart is one example of it. And you can see in Q3 2022, the secret gold buying really stepped up in a big way. What was happening in 2022? Well, obviously the war, in Ukraine, right? And the sanctions, et cetera, et cetera. So China said, hold on, we need to stockpile a lot more gold. And when you know you need to buy a lot of something and you're going to be in the market for a long time, you try not to advertise exactly how much you're buying. It's kind of a smart move. So they're being smart, and they've got a lot of stealth buying going through London, 400-ounce gold bars being shipped to Shanghai. So China's, official stockpiles are like 2,300 tons, about $200 billion of gold. I would estimate that their real stockpile is probably closer to 6,000 or 7,000 tons, near parity with the US. So they're ready to pull the trump card. And gold is the trump card, and they're de-dollarizing. Gold is going up, in the reserve assets, and all the BRICS countries are buying gold, and everybody knows that. So what is gold? So to get out of this mess, to at least some extent, China's going to have to do something with the currency. They're going to either have to revalue it higher or devalue it. And actually, it's kind of funny because you say, well, it's going to go up or down. It's not that clear what they're going to do because they have the choice to do either, and it depends upon what Trump and his team kind of force them to do. Now, obviously, they don't want the yuan to drop, and Trump doesn't want it to drop either. So that would be a move that would probably cause a crisis and more problems. So I don't think that they will allow the yuan to fall further against the dollar, or at least not in a big way, okay? And I think actually it's much more likely that China has been stockpiling gold for the last several years, and including with all the stealth buying, because they're going to revalue the yuan higher against the dollar, and they're going to do a partial peg to gold. Now, when you have a debt problem in your economy and you make the currency worth more, that could be very problematic for the debtors. So at the same time that they do this, they are going to have to do a huge stimulus on the fiscal side. So Yuan higher against the dollar, peg the yuan to the price of gold at some number. The dollar price of gold will go up, and then they do a fiscal, a huge ocean of stimulus, in China, and force inflation, right? Because they're experiencing falling price levels, a stagnant, falling economy. So this is an extraordinary move. Okay, it's like the big button on the table that you press when you have no other choice, and it will appease Trump. And I think this is the explanation for the gold strength that we've seen for the last year, the last couple of years, and even in the last month. And I expect China's gold buying to continue as they sit at the bargaining table with the Trump 2.0 team. And there's a lot more to this, and follow me on Substack or on X, find more of my content, and follow along with Trump 2.0 and the Trump-China affair. Thank you.